welcome to IPO Watch. I'm your host Nikki Mirchandani. The first main board initial public offering of 2024, Jyoti CNC Automation IPO, of course opens for subscription. It has opened for subscription today and marks the restart of the IPO season. That too on a good note, with the retail category now perhaps being completely, the retail portion being oversubscribed by the IPO. Now, Jyoti CNC Automation essentially is headquartered in India. It specializes in manufacturing and supplying CNC machines. But let's delve into the company's strategy, financials, and outlook with Parakram Singh Jadeja, the chairman and the managing director. Just to make it a little more shorter, Parakram, I'm just going to keep it at that. You have a little tricky name, I would say. But let's get on to the basics first of your company. How different is your business profile as compared to the existing peers in the market, Alga Equipments, Lakshmi Machine Works, Triveni Turbines, TD Power System? What's your USP?
So our USP, we are into a metal cutting industries manufacturing and mainly on aerospace, defense and high-end manufacturing area there. So that's the key differentiators are like that, and particularly this let's say some of the players are not into fully in a machine tools, they are into a different industries also there.
Okay, so you are basically saying that you're more integrated as compared to others?
Correct. Yeah, and we are fully integrated into a metal cutting machine manufacturing there.
Okay, and any difference with the kind of sectors or the clients that you kind of offer your service to as compared to what's existing in the market?
Yeah, it's completely different, and let's say we are into more and more into metal cutting industries and that to high-end manufacturing like aerospace, defense, and now EMS industries also there.
Sure, we're going to touch base about the segment-wise breakup in just a bit.
Correct.
But 100% is fresh issue. There is no OFS,
there is
unlike
no
most of the IPOs that we've seen in the primary markets. The company plans to allocate around 475 odd crore just from the net proceeds to repay the borrowing per se.
Correct.
Post the issue, how much will the debt figure come down by, and also your interest expense for this financial year?
So basically, the debt to equity ratio will reach to 0.25%, and our direction will be there to be completely debt-free companies on next 2 to 3 years there.
So by 2025 is what we can expect the company to be debt-free?
Most probably.
All right. Also, I'd want to talk about the interest expenses. How much do you think that will come down by?
So the last year our interest expense was close to 90 crores, the financial expenses like that, and we are paying largely these debts, so we can assume that close to 50-55 crores will be reduced there.
Okay, all right. Also, I'd want to understand a little bit about your debt to equity ratio. That comes down significantly from what the level is currently.
Correct.
But it is at 3.25 as of first half of the financial year.
Correct.
But how much are you would you be comfortable with? Sure, at this point of time, you would see that reduction coming through.
Correct.
But for the future, or maybe from a 3-year, 5-year perspective, what's the comfort level that we can work
So basically in the next 3 to 5 years, the way we have a robust order book are there, and we are going to execute them, and then basically our utilization will come. So for a 3 to let's say 3 years near term, we are not looking any kind of a debt requirement. We are enough to generate the cash to fulfill the next growth cycles are there.
So inflows is how you're going to basically internal accruals.
Internal accruals are going to be meet our next requirement for the next 3 years.
What is your growth strategy looking like? How many more plants do you intend to add up? What kind of utilizations are you looking at?
So the way, let's say today our the plant has a capacity to 4,400 machines, and with the some of the balance capex, very minimal capex to be there, and we say there is a bottleneck removal, we are going to do it, and that capacity will reach to 6,000. We are looking to be close to 90% utilization will come in the next 2 to 3 years there.
Sorry, you said the number was?
The 6,000 is going to, capacity will improve from 4,400 to 6,000 with some bottleneck removal there, and that is not required too much capex to be there.
So
very
the
minimal
utilization
capex
would improve by how much?
And utilization, we are looking based on this order book, we are looking to be our first strategy to utilize fully on this plant, and close to 90% we are looking, and then we will look to the next phase of expansion like that. And I would like to tell you that we have we can do this kind of a total 4 phases on the same land to be there. So based on our master plan like that, this is the first phase this.
All right.
Yeah.
So this 90% utilization rate compares to what utilization rate right now, and that is achievable by which year?
So basically today let's say based on the 4,400, the last year was close to 3,300 machines we have built. This year we are going to utilize up to 70%, and next year we will reach to close to a 90% like that.
All right. Yeah. So FY25 again is what we can look at for your utilization too.
Yeah.
Okay. Let's talk about your losses that you've posted for FY21-22. The only concern that I could see in the financials was the financials were a little patchy. They were not drawing a correct trend per se, where we could understand as to what are we working with. You posted losses in FY21-22. You just turned around profitable with 15 crore PAT as of FY23. In the first 6 months, the number stood at 3 crore. Now, how do you think you'll be able to outperform the profits that you've registered in FY23, and if yes, why?
So you have to look at this way that let's say you have in our website numbers have been declared, and at a standalone at the India business has never made a losses there. This losses has come through particularly our subsidiary company in France, and that too passed through this the COVID time, and you know that all the aerospace companies was passing through almost 2-3% of our total world aircraft was grounded for more than 2 years there on a COVID period. We have come back from let's say the order book and everything has come back in the last 2 years, and being these are the long manufacturing cycle, the one machine's time to manufacture close to 12 to 15 months. So things have started improving in FY23, and with this utilization, this order book execution, will be seeing the numbers much better in terms of a 24 and to be 25 there.
All right, point well taken. So now you said the losses essentially were incurred in aerospace business. That was your overseas subsidiary, which was a drag on your financials.
Correct.
So help me understand how has the performance been of this subsidiary in this financial year?
Yeah.
And how's the aerospace business also performed?
Correct. So let's say the last year this our subsidiary has done close to 130 crores of a top line, and the utilization of the total plant is just 20% in there. Okay, so that is going to be based on this our order book today. You have out of this 3,300 crores worth of orders, out of that 1,900 crores worth of orders are only in aerospace and defense, and that too at my subsidiary level there.
Okay.
Yeah. So and being on this is a large manufacturing let's say cycles like that. So this year we are looking to be close to utilization will reach to a 60 to 65%, and full utilization will come on next year there.
All right. So if 15 crore is what you've posted in FY23.
Correct.
And if your utilization rate essentially in the overseas subsidiary is going from 20 to 60 odd %,
correct,
which means that the overseas subsidiary will no longer be a drag.
Yeah.
What kind of profitability can one look at for this financial year? Do you think you will be outperforming that number?
So we'll be outperforming there.
By a huge margin?
Maybe a good margin.
Okay. All right. Can we look at a doubling of the number of 30 odd crore? Because see, the first half of the financial year isn't really giving too much of fodder to talk about. It's not giving it the conviction that 3 crore is what you've registered, annualized at 6 crore.
Yeah.
How different second half is?
So basically always this industry, the second half is always to be a 40-60. Okay. So you have to look at that the last year numbers also and this year numbers also. Okay. So based on that you can let's just arrive the what are the numbers can be there.
Absolutely.
Almost is a 1:2 kind of a things like that.
Okay. Yeah. All right. Point well taken, and thank you for the clarity. Talk about your cost management. The losses have been attributed essentially due to factors like fixed finance cost, which I'm sure you're going to be taken care of once the debt comes down.
Correct.
The other perhaps concern is the long working capital cycle and the fixed expenses.
Correct.
How do you intend to resolve that?
So I'd like to tell you the long working cycles also we are improving drastically there, because until today we were working on to 200 variants of the models there, and the way the scale up operations are happening. So until today, let's say whatever the SKUs are there, on the same SKUs we are doing the multiple time of a business there. So minimum order quantities requirement is to be optimized there. Thus our let's say in our RHP also we have mentioned that we are looking from 280 days to come down to within 2 years to be 160 to 175 days of a working capital requirement there. So there we are able to maintain the cost very well on that, and utilization will come. The fixed asset turnaround also will be improving, the cost also will be improved there. And already financials, we already mentioned that we are improving drastically in this coming year with this IPO prospects there.
So 3 crore is what you've penciled in the first half, and 5 crore is what can be derived from the second half, given the conversations that we've had. So we're looking at a number of roughly 8 to 9 odd crore. Have I got that right?
No, you have to look at that way. The way, let's say, utilization will come. Okay.
So
your operation leverage will come there.
So okay.
So operation leverage will come. You can have a much better.
So utilization and look at in the first half is how much, and how much do you expect it to be by the end of the financial year?
So the utilization on first half was close to 50%, and we are looking close to a 75 to 80% utilization will come on end of this year.
Okay. So that's two essential positive takeaways.
Correct.
A is the utilization rate is expected to improve in the US subsidiaries, as well as overall the second half is expected
Correct.
to be better.
And second, you have to look at that, let's say, compared to the last year. Let's say this aerospace and defense business is a better margin for us. So that is also the delta will come on to that.
Okay. Yeah. Let's also talk about your EBITDA margins, which have doubled from 5.5% in FY21 to nearly 11 odd percent in FY23.
Yeah.
The first half, the numbers have inched up to 15%. Now, what's the sustainable range, since the numbers look again, a little different from where you started?
Yeah.
So, is 15% doable on an annualized basis?
See, you have to look at that, this H1 numbers at 15%, okay, and utilization is still at 50%, okay, and this will improve furthermore. So there will be room for improvement much more there. Okay, so there is a operation leverage will come on a second half.
Okay, so 15% is doable on sustainable basis?
It will improve much more than that.
Okay, so 20% is the range that we're working with.
We are looking into let's say once the execution will be going very smoothly, things will improve much more there.
Okay, so between 15 to 20% is your EBITDA range. And what are the levers apart from utilizations, of course, and the operational
Then the model
leverage?
mix are there.
Okay, so can you give us
the
more
model
details?
mix in terms of let's say the auto and auto component to aerospace industries, let's say. Okay. Yeah. Okay. So I like to tell you one thing, that let's say average of a machine prices in a auto and auto component space are, let's say, less than 50 lakhs. In this aerospace machine, the average machine what we have in order book is close to 20 crore plus one machine there.
Okay.
Yeah.
Let's also talk about your segment-wise breakup in a little more detail. Correct. Because that's essentially where the alpha is expected to come in from, right? Correct. So out of 5 space, aerospace, that's the first segment. Second is auto and auto components. Correct. Third is general engineering. Correct. Fourth is dice.
Yeah.
And fifth is EMS, which you're of course bullish on.
Yeah, correct.
Which one is more margin accretive in nature?
Aerospace and defense.
How much is the margin difference?
So basically, it's a combination of all. Let's say I will not able to tell you the exact numbers there. Okay.
But what's the difference? I get your point. There are some restrictions that you have to follow, but I get your point. In terms of aerospace segment?
So it is not in my document. So basically, I can say that the combination of both will improve things like that.
Okay, so
substantial differences like
so
that.
Aerospace is more margin accretive.
Correct.
Is it a 3 to 5% range, or it's way higher than other components?
If I make any numbers, it will be fixed there. So I'll say it's a way higher numbers like that.
Okay, because the reason why I have been asking this is, you essentially also, I guess, EMS is what you're pretty bullish on as a segment.
So EMS is going to give us a volume.
Right.
Okay. You look at that, the industries are growing so great pace are like that. Okay. You look at the numbers of all mobile manufacturing and all like that. Okay. And we are working with this all world class companies, and we are looking to be much more business on that space there.
Okay.
Yeah.
All right. So EMS is for volumes and aerospace is for value.
Yeah, it's part of
That's the strategy.
That's the strategies like that.
Okay. All right.
And these are basically the auto component, general engineering, dies and mold is a base, and these are the two growth drivers like that.
Okay.
So let's say the market, the Indian consumption will grow based on the auto and auto component, and we our another two these areas are the two growth drivers like that.
What I also figured out or analyzed looking at the past financials was the fact that your auto and auto components percent to your revenue mix has improved from 36% to 47%. 36% in FY21 and 47% in FY23.
Correct.
Do you expect that to now come down and perhaps get more contribution coming in from the aerospace, which otherwise was dull in the last 2 years?
Correct. So basically, even the in a growth, the situation also, let's say aerospace and defense is going to contribute close to 40%. If you look at that, our today's order book, it's close to 58% is aerospace and defense order. Out of this, 3,300 crores there.
Okay, so aerospace is 40% of your order book. EMS is?
No, order book it is a 58%.
58%.
Yeah.
Okay, and 10% is your EMS.
8% are 8 to 9% are EMS there.
Okay, so you intend to change that mix anytime soon? Because
it will come naturally, because once we execute this order book, the numbers will be completely changed there.
That's exactly what I was trying to understand.
So we are looking to be, let's say our wish is to be balanced. Okay, like auto component, we like to have a close to 25 to 30% there, and other than this two, let's say 40% we are looking to be aerospace and defense, and close to 30% we are looking to be a EMS business to be there.
Okay, so
that's the wish list are there. Basically.
Sure. Yeah. So you're looking at this kind of
that's the strategies.
Strategy for in the next 3 years, in the next 5 years. How are you looking?
Within the next 3 years.
3 years.
Yeah,
okay.
Within the next 3 years.
All right. So by 26-27 is what we can expect the growth to. Perhaps the order book, if it goes in the direction that
Correct.
you're thinking.
Similarly. Yeah.
To look at. Okay. Fair point. Let's talk about your dependence on 10 customers, which is essentially, I'm sure you must have got that question enough and more, that your concentration is a little higher.
Yeah.
And for the 6-month period, it's actually increased to 40% from 20% seen. So it's almost doubled up.
See, basically what is happening that we have a very diversified customer base. Okay, we have more than 12,000 customers are here. And every year these capex cycles are moving around. Sometimes one customers are investing on a large way, so it is changing like that basically. Okay, next year you will not have a same customer, but you have another customer, will have a top 10 customers to be there. Okay, but largely we are seeing in a forward direction in the next 2 to 3 years. This will be a focus into let's say 8 to 10 customers and close to a 20 to 25% business to be there.
Okay, just help me understand this a little better.
Correct.
You said you have a diversified customer base.
Correct.
And at the same time, you've seen the concentration in the top 10 clients. So is that a conscious strategy?
See, I never said that it's a concentrated of a customer. It's a industries. Customer in the same industries, customer will be different there. Let's say an auto component, there are many companies are here. So, and we are into complete space are like that. So they're tier 1, tier 2, tier 3 suppliers, also our customers like that. So it's a basically very fragmented this industries, very large industries like that. And we have a very large diversified customer base are like that.
Since we are talking about customers, why don't you tell us the key customers within the EMS segment, within the aerospace segment, and auto component?
In auto and auto component, let's say all Tata and their tier 1, tier 2 suppliers like that. Bharat Forge is our customer like that.
Okay.
This Bosch is my customer like that in auto segment. In aerospace, we have this all the ISRO, the BrahMos, all the ordnance factories, and particularly let's say we have a company called as MBDA, is a French missile manufacturer like that. Okay. And there are in a EMS segment, we have a very watertight agreements and everything like that. I cannot name of the customers and all like that.
Okay, so EMS is where you'd want to perhaps maintain the confidentiality of your customer. Okay, point well taken. General engineering is the one perhaps that we missed out on.
Yeah.
Because we've seen the decline also coming in from FY21 to 23. Are you not more bullish on this segment?
No, we would like to maintain our market share on those areas basically. The market is improving, we are also participating there.
Okay. So essentially the growth strategy now will be more focused towards the EMS and the aerospace segment.
Yeah, that is the growth spectrum like that. We have a 3 clear-cut strategies are here. Let's say we would like to be a expander, let's say on a area that's a growth potential like that, and it's the 4 industries like that. One is to be aerospace and defense, second is to be EMS, and then is to be EV is to be there. These are our expanding we are looking, that's strategy.
EV as well in that case.
EV is also that.
Which clients do you have within that
So basically
segment?
we have developed many machines to produce the motors, components, as well as the battery cell manufacturing technologies also. So we are waiting, these people will going to come over here and we will support them.
All right, that's extremely interesting line of business with a diversified mix in your revenue, but we're just going to leave it at that. And thank you for taking out the time and joining us here in the studio to have this conversation.
Thank you. Thank you.
All right, with this, it's a wrap, but few takeaways from the conversation that I'd like to highlight. Debt to equity ratio is expected to go down to 0.25 times post the issue. The company is expected to be debt-free by 2025. Losses in the subsidiary essentially from the aerospace division is also expected to come down, or let's just say higher amount of utilization coming in from that one. Apart from that, it is, if you talk about the strategy, there's going to be more focus now towards the aerospace segment, which is more of a value driver, and EMS segment, which is more of a volume driver. But with this, it's a wrap, and goodbye from the entire team who puts this piece together for you. Thank you so much for watching.